Hey guys, Jeff with optionboxer.com. Got another video for you tonight. Just put the finishing touches on this particular video. There was a lot that went into this, and unpacking it's going to take us a couple of minutes here, so please be prepared for that. Before we get into the back test, please know that I am not a registered financial advisor, and this video is in no way a recommendation for you to buy or sell any security or attempt any options trade or strategy. Just make sure you're doing your own research prior to trading or investing. That out of the way, let's go ahead and just take a look here at what I've got. First things first, this spreadsheet that you see on the screen, I'll go ahead and make it a little bigger. The spreadsheet that you see on your screen here is available for free at optionboxer.com, and I'll leave a link to it in the description for those that are interested in it. But it's an Iron Condor spreadsheet. For those that have watched any of my videos, you know that I like the Iron Condor. I trade it fairly consistently. And so I'm just looking for maybe a little bit better way. I've been successful over the life of my Iron Condor trades, but maybe just looking for a way to be a little more successful, or possibly you're looking for a way to be a little more successful. And so what I've done is I've taken three different, management strategies, so to speak, and I've tested them against different tickers or different assets and across different time frames. And we'll look at each of those here momentarily. What I didn't do is I didn't change my technical analysis approach or my rationale to get into an Iron Condor. All I changed was the management style of and it was pretty enlightening to see how it all shaped up. Before we go through all that, please know that there was a lot of data, again, just like the Iron Condor back test I did a few days ago. There was a lot of data going back and forth from the platform into the system, or into the spreadsheet here. You can see all the numbers I had to type in. This is all manually done. I don't have any fancy back testing software that'll do this for you. But I didn't change the criteria to place a trade, and we'll go ahead and take a look at the platform here really quick, and I'll go ahead and walk you through what I was looking at. So the first thing I did was I used the 1 year, 1 day chart for every strategy, for every management strategy. I did 30 to 60 days to expiration, and you'll see why I didn't just put 30 there here in a second. The RSI was neither overbought or oversold. This wasn't paramount in my decision making, but it is nice to see if that's if it's not overbought or oversold, somewhere in between. This was the kind of the biggest one. Price was inside the 1 standard deviation channel. Again, the IV rank was at or above the green line, which just meant IV was inflated at that moment. Again, not paramount, not critical, but most of the trades I took did include that. And then the TTM histogram was moving towards 0. So those were the TTM and the price inside the 1 standard deviation channel were the two big ones that I looked at. And I'll just kind of walk you through. So looking at it right here, you can kind of see this light green line that's kind of highlighted when I hover over it. That's the 1 standard deviation channel. And you can see at this point, price is in between it. I took trades even if it was right at the line. It didn't have to be right in the middle. I took it when it was right at the line or at the top line, either one. You could see as of today in US Steel, I could potentially take a trade based on this criteria, although it wouldn't be ideal because you can see that the IV rank is down here towards the lower end of its range. RSI looks good. Everything looks good based on the criteria that I used for this strategy. You've got the price inside the 1 standard deviation channel. You've got the TTM histogram moving towards the 0 line, or what I call the 0 line here. I don't know if it's actually called the 0 line, but regardless, it's moving towards the middle, and it's not at a peak or a valley here. And so this would be good enough for me to take a trade, but I probably wouldn't, just given the fact that the IV rank is so low. So I'd probably wait another week or two to get into a trade. The only other thing that you should know about all of this is I only managed the position on Fridays for the most part. I think there was one strategy, but I can't remember going through all this. I can't remember which one I managed it, and maybe throughout the course of this video I will. But for the most part, I just managed it on Friday. So if I had looked at this today, or let's assume this is a Friday, I saw this chart, I'd probably put it on a separate watch list, and then I'd click and I'd wait till the next Friday. And if price was still inside the range, and the TTM and the RSI and everything still looked good, and then just maybe waited for this IV rank to increase a little bit. But regardless, that was the strategy that I used or that was the technical setup that I used for every one of these strategies. And then the only difference was, again, the management style. So we'll go ahead and walk through all of these as quickly as I can. The first management style was super simple. I just basically wanted to take a 50-50 risk reward, and then I was going to hold it to expiration. Win, lose, or draw, it didn't matter to me. I was setting this up based on this criteria, and then I was going to manage it this way. So you can see here my total credit was 1303, total risk was 1297. So I took in just a little bit more credit than I did risk, and so you can see it was about 50-50, just like I had anticipated. But over the life of this strategy, I only made $35. You can see I traded. Oh, the other thing you should know is I traded this from January 2020 and all the way till October of 2021. And all of these strategies are, with the exception of my model iron condors that I built over here, are traded within the time frame of January 2020 and December of 2021. So not a long period there, and you can see there wasn't a whole bunch of trades, and some of these strategies didn't produce enough trades to to be statistically significant, I guess. But they do highlight a couple things, and we'll talk about those as we go. But I took a total of 12 trades, 6 wins, and for a win rate of 50%. So basically, I just kind of hovered around zero. I would win one, lose one, win one, lose one type thing. I'd win 2, lose 2. At the end of the day, not overly profitable on AMD right here. One thing I should show you is I went ahead and created this chart just so you could kind of see the price movement. So AMD it theoretically wouldn't have been a good candidate for an iron condor, because you can see its price over the duration. So January 2020 all the way to November 24th. I just didn't, I don't know, for whatever reason, I didn't get the data here all the way to December. Well, actually, it wasn't available. I'm sorry, it wasn't available on Yahoo Finance for me to pull that data in. So I got the last available date on a weekly basis that they had, and you can see over the life of this, over the life of AMD here, over the time period, there was a 228% increase in price. So you can see that wouldn't have been ideal for iron condors. Although this period in here between, it looks like about August of 2020 and about July of 2021, that would have been probably an ideal time period for an iron condor. Nike here in orange, you can see it grew by 66%. So not as maybe not as volatile, I guess, or didn't see as much growth. So you probably had more opportunity for an iron condor, and you'll see that you actually did as we go through these numbers. And then the United States Steel was the most ideal, in my opinion, to an iron condor. Although because it wasn't, I mean, it grew by 103%, but you can see it didn't make any huge peaks or any huge valleys. I mean, even through the pandemic here, you can see it remained relatively flat. But getting back to where we were, you can see again 2.7% over the life of this, which was 2 years. So not a great return there over 2 years. Nike, everything was exactly the same. The only difference here was that I tested it over 45 to 90 days. Again, same setup. I just was trading it over a longer time period. A little bit more profitable, made $161 or 8.8%. Again, tried to keep the total credit to risk about 50-50, a little bit shy of right at 50-50. So take that as you will. But that's how that played out there. Then I traded United States Steel over 30 to 60 days. Oh, sorry, the United States Steel 60 to 120 days, and you can see I had total trades 7, had a nice win rate of 71%, and had a nice profit as well. So this was an ideal scenario, just buying longer term or just selling longer term iron condors in United States Steel, and then just letting them expire. Of course, because I was trading between 60 and 120 days, there just wasn't a lot of trades to be had over the period. But regardless, it made 48% return on my risk there, and you can see again was about 50-50. So moving into the next management strategy, you can see this was something. This may not be as common. It's certainly not a way I've traded iron condors very often, but I was going to leg into each side, and here was my criteria for legging in. So the first leg I was going to trade right at the money with the with the short side in the money and the long side out of the money. So I was right at the money, and I'll just go ahead and pull up the platform so you can see how I would do it. If I was trading it here on United States Steel, I would sell this one and buy this one. That's how I was trading it. If I was doing a $5 wide, I would just go a little bit more there. I would just basically go in the money as far as I was going out of the money, and that's how I would set it up. So that was the difference there. And then the second leg, when the first leg was out of the money, so actually this was the strategy where I tried not to manage it just on Fridays. I tried to pay attention to when price dipped or when price rose, because I was legging in. I wanted to try to, as soon as it went out of the money, I wanted to try to set up my second leg, and I did that the best that I could. And I was going to set up the second leg out of the money or at 30 days to expiration. So again, if it never went out of the money at 30 days to expiration, I just opened the second side of the iron condor. And then I tell you that here, if first never goes out of the money, second at the money at 30 days to expiration. Oh, so the only difference here is if it did go out of the money, I would open the second leg out of the money. If the first leg never went out of the money, I'll open the second leg at the money. And what you'll notice, if you are following what I'm saying, you'll notice that at times I ended up opening what was basically an iron butterfly. So there were periods where I opened a trade that looked like this. So my loss would be minimal, but the probability of it happening was also minimal because it had to fall within a range. And sometimes it worked, sometimes it didn't. But regardless, that's how I set it up. And then I was going to hold this to expiration. The only other thing you need to know about this is my directional bias is when I looked at the chart, so long as all the other criteria was in agreement, I just looked at the shortest term trend possible. So if I was looking at United States Steel here and price had fallen down here, but then it started to climb back, I was only looking at this short term move right here. So a week, 2 weeks, whatever happened in the last week or 2 weeks, that was the direction I was opening. So if I was trading that here on United States Steel, I'd be opening a put spread in agreement with the short-term trend. So that's how I set that up, so that you have all the data there. It ended up being just an incredibly profitable approach, and I never would have suspected it going into it. I traded this on Nike. From 30 to 60 days, there were a total of 9 trading opportunities with a 78% win rate. And then the return on risk was 108%. You can see the profit and loss was staggering. You'll see the total credit received, because I was trading right at the money on many circumstances, was far more than the total risk that I accepted. But you can see my most profitable strategy by far was here on Nike. I did everything exactly the same here on United States Steel, but you can see the results were very different. You can see, however, I only lost $35. You can see I took in a total credit of $410. I kept this $1 wide. The Nike strategy, I did $5 wide. I kept this $1 wide because for many of us, we don't have, $200, $300, $500 million accounts. And so we want to start somewhere, and we want to start small. But you can see I only lost $35 over the period here. And I really only risked $90. Had I continued this strategy, I probably would have been able to realize a profit. You can see it just the losses were pretty small, and there just wasn't enough trades there over the period, because I was trading this 45 to 90 days. And the way it worked out, the chart wasn't in agreement. When one trade ended, I had to end up waiting 2-3 weeks to a month before I got into another trade. So I only took a total of 5 trades there, but I only lost $35. So really not a bad way to trade an iron condor, even though the outcome was slightly negative. Traded this the exact same way again over AMD. And if you'll remember the price chart here, AMD was not ideal for trading iron condors, just because it saw so much growth during the period that I was testing. And you can see I lost $239. Again, my risk was much smaller than the credit I received, but over the course of this, I lost 32% and I only won on one trade. Same thing, not a lot of trades here, only 4. Traded this 60 to 120 days, so as you might expect, less opportunities there. So moving into the final strategy here, yeah, so this was where I traded the kind of the prototypical iron condor that you hear about. The 20 to 80 risk reward. That way you have a high probability of success. And I guess, 62%, you could say that's a high probability. And we'll look more at that here when we look at the results all together. I did win more than I lost. So I guess the high probability did hold true. The only problem is I took in so little credit and took on so much risk that at the end of the day, I ended up losing. There was 13 total trades here, and you can see my winners were small. Right here, took 13 trades, came out with a loss of $244, but I did have a high win rate of 62%. But regardless, I adjusted it at 10 days to expiration, traded this between 30 and 60 days. But again, outcome unfavorable, trading the high probabilities. And I did this $1 wide. Again, you can see, and only trading $1 wide and losing $244 is not particularly appealing to me. Moving along, AMD here. Again, AMD was not an ideal candidate. Of course, we wouldn't know that going into it, but AMD was not an ideal candidate for trading iron condors because it saw so much growth over the last 2 years. But you can see my total risk was 4,217. Total credit was 1,200. So really a third. A third of my risk is what I received in credit. And again, a losing position. Win rate was, again, pretty high. I think this was the highest at 73%. But at the end of the day, it was still a losing campaign. So it's hard for me to feel all that great about it. The only difference here between the 30 to 60 days on United States Steel was that I adjusted this one, sometimes one leg, sometimes 2 legs, and you can see here I adjusted just the 1 leg if it supported it. This was the worst of all of them. Trading Nike, in Nike, if you remember over here, Nike didn't see that much growth. In fact, it saw less than either two. So from strictly from a price standpoint, Nike didn't move as much. So you would think Nike would have been a better scenario, a better candidate for trading the 20/80 risk reward or the high probability setup, and it just wasn't. So my win rate was still above 50%, but again, the credit that I received was far less than the total risk, and it started to click for me as I was trading this strategy that I was taking on so much risk that it was almost inevitable that I was going to be looking at losses. And I have traded an iron condor this way more times than I care to admit. And for me to see it in this form was just shocking. This first trade is a little bit misleading, though. Remember, that's during the coronavirus pandemic. Only took 9 trades for this strategy. But because I managed it at 50%, I ended up closing my any potential winners well before I was able to realize the maximum profit. So this $1,000 loss might have been a little bit better, but because I capped all my winners at 50% and held all my losers to maximum loss at times, just not a good strategy, not a good scenario. And then finally, I just kind of compiled all the results here. We've already talked about all of this that I've got here. The only thing we haven't looked at is the model iron condor. So basically, let's run through here. So AMD 30 to 60, I had a 2.7% return on my risk there. Nike 45 to 90 had 8.8%, so certainly not terrible. Had a decent win rate. United States Steel had a 48% return, so probably the best and easiest strategy was just longer term iron condors. Required no management. You can see hold to expiration. Required absolutely no management. So you basically set it up, and then the only management is to close it at the expiration date, or just let it expire and do what it's going to do. But Nike was by far the most profitable from 30 to 60 days. I took on 9 trades, had my best win rate of 77%. So I was a little off. I thought AMD at 72 was my best, but 77%. So that was by far the most profitable management strategy that I traded. And then lost 38% trading 45 to 90. So this was the only successful strategy trading right at the money. that I found out of these three. So I apologize, but it was my most successful. But again, limited time frame, so you know that strategy should probably be tested across a wider breadth of market environments. And then moving to the last one, which is the way I think probably more people than would care to agree, trade the Iron Condor. Every scenario was a losing one, whether it be a short term, intermediate term, or a longer term Iron Condor. Every strategy was bad, although the win percentages, as you would suspect, trading a high probability Iron Condor were relatively high. You know, I used that data to create these last two trades here, and we'll take a look at them here. But basically, I wanted to take the best management style from each of the most profitable strategies, like this one and this one. So those were probably my two favorites, and that's how I kind of created what I'm calling the model Iron Condor. And we'll come back and look at these key takeaways here in a second. So I traded this from January of 2020 through November of 2021, and this was on AMD. And I picked AMD specifically because AMD was a loser in every other test. You can see, well, with the exception of the first one at 30 to 60 days, but it was a small winner. It was a huge loser here. And again, another losing position there. So with none of the three management styles did I see profit on AMD. However, I traded it this way with the, you know, kind of changed my management approach here, and ended up seeing a fairly nice profit over the time period. So I took a total of 10 trades. There was a 70% win rate, which is great, and then a 30% return on my risk. You can see I kept my total credit to risk about 50-50. It was a little less on the credit side. Technical setup was identical to all the other strategies. I didn't want to change that. The only thing I did change was I was going to leg into each side. The first leg I was going to get into at 60 days to expiration. The second leg I was going to get into at 30 days to expiration, regardless what happened with the first leg. I just wanted to keep a 50-50 risk to reward. So if I got into the first leg with a 75-cent credit, I was looking to get into the second leg, no matter where price went, at about a 75-cent credit. So I kept my 50-50 risk reward paradigm there, as you can see, and I was going to hold them till expiration. That seemed to be the most favorable approach, rather than try to manage the winners or the losers. And then again, the directional bias was with the short-term trend. But at the end of the day, made $802 there. So, you know, once I saw that looked pretty good, I was like, okay, well, I've got to test it on SPY. SPY is probably the most heavily traded instrument for options traders, or at least in my opinion, or from what I know. And if you've ever traded Iron Condors on SPY, you know it's ridiculously difficult because it only seems to go one way, and that's straight up. Or at least over the last 10 years or so, that's all we've seen. With the exception being maybe 2015 and 2018, I think we had some kind of sideways movement there. But I did test it for a year longer, so I went back to the January of 2019. And if you remember 2019, you know it was a fairly bullish year. I think the market returned 29% or something, S&P did. So I took 14 total trades. 9 of those were winners, so I had a nice win rate. My management strategy was exactly the same as it was on the model Iron Condor for AMD here. You can see my risk to reward. Again, my credit was just a little bit less. The only difference here is I traded at $3 wide, but everything being equal, I traded this all through 2019. And then, of course, through the coronavirus pandemic, and it came out with a $357 profit. So certainly not bad there, and was worth the time. But both of them had very nice win rates, above 64% on both of them. Took 14 versus 10 trades. Obviously, the AMD trade was a little bit better. What I did notice throughout all of these trades through all of these strategies, is that the SPY was the most difficult to find setups for, because it constantly finds itself at the upper or lower band of the standard deviation channel, which was the primary technical indicator I was using to find setups. So individual companies seem to work better, and it may be of interest to create a chart similar to this, so you can see over the last year or so how much prices increased for whatever your asset is. And if I was, as I go forward, probably what I'll do is I'll find some companies that I like, and I'll plot them onto a chart similar to this one right here, just to see their growth over time, and see which one maybe offers a more favorable market. So what I wish I would have done and what I didn't do is tested United States Steel using kind of this model approach that I created, but I didn't. I wanted to test AMD because it was the only one that lost on every single strategy, or it was only a small winner on this very first strategy here. But regardless, some key takeaways here to wrap this video up. Trading high probability iron condors is the worst possible approach, both in my opinion and based on these results. Again, these are limited results over a limited time period, so you'd probably want to look at this over a wider time range and over different market environments. But certainly eye-opening and enlightening there to find out that the way I've traded iron condors many times was possibly the worst approach. That method assumes greater risk and less possible reward, so it's not ideal. When you're looking at this on a longer term time frame, just not ideal to take on that much risk. It's only a matter of time before you get burned by taking on that risk. That method combined with a 50% profit target is a recipe for disaster, in my opinion. So keeping your losers all the way to a maximum loss and capping your winners at 50% is just no good. I think the goal is to strike a balance between premium received and probability of success. So when the IV percentile or IV rank is elevated and the options premium is inflated, you can go a little bit further away from the money with your strikes or with your short strikes and give you a little higher probability of success while maintaining a somewhere near a 50-50 premium to risk to reward balance. And that seemed to be the most ideal, or maybe probably the biggest takeaway from all this is you want to strike a balance between premium received and the probability of success. Iron condor is seen best in those instances where the probability of success is greater than 50 and the risk reward is above 50. So again, that goes back to the balance. And then the only scenario in which longer time horizon iron condors made sense would be on a slower moving market such as US Steel, as we talked about briefly. And then the data entry errors are always possible, like I mentioned, and further research would only support or deny any of these findings. So there it is, guys. I mean, pretty clear in my opinion, based on this test, that legging into an iron condor is ideal, and legging into it with a 50-50 risk to reward while also maintaining a high probability is a recipe for a successful iron condor campaign. So that was very long-winded. I'll try to cut this down as much as I can, but guys, thanks for watching, and if you like the video, please do like and subscribe, comment. I'll reach out as soon as I see the message come through to my phone, and we can discuss if you have any questions. But guys, thanks for watching, and thanks for those that have subscribed and do watch these videos. Let me know if there's something you'd like to see me test or something you would prefer other than what I'm currently doing. I'm just looking I'm looking to maximize my own profit and then share my findings with all of you. So if you have anything that you would prefer to see, please do reach out to me. But again, thanks for watching, and we'll catch you on the next one. See you later.